Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Be sure to subscribe to our recently launched Substack, the Planet MicroCap newsletter, for free at microcapnewsletter.substack.com. I'll be sharing all recent podcast episodes from Planet MicroCap and due diligence. Plus, every Sunday, I put out our weekly microcap wrap to show how the microcap space has performed every week and compare it to the broader markets based on data from the Microcap Review Index. Again, to subscribe for free, go to microcapnewsletter.substack.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Tim Travis, CEO, CIO, and founder of TNT Capital Management. I've known of Tim for a while, but he recently made an appearance on Value After Hours with Tobias and Jake, and I wanted to have him on to discuss all things value investing. Tim is a deep value investor who closely follows everything that's been happening in value investing circles and beyond. So pretty simple. I wanted to have him on to ask him all about it. So thank you again for tuning in to episode 237 of the Planet MicroCap Podcast, and please enjoy my conversation with Tim Travis. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back, everyone, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And for my guest today, it's actually our first interview of my new digs. That's why I literally have nothing up here behind me if you're watching this on YouTube. But in any event, I got Tim Travis on the show today. He's the CEO, CIO, and founder of TNT Capital Management. I just heard Tim on Value After Hours on Toby's podcast, and I had to have him on because why not? I thought it'd be an awesome conversation. So with that, Tim, thanks for joining me today, man. How you doing?
Oh, thanks for having me. I'm doing great. Appreciate you having me on the show and looking forward to it.
Absolutely. Wait, so for those who are watching on YouTube, which president is that? George?
It's Hamilton.
It is Hamilton.
It's Hamilton. So, but I would like to say that this was before the play got super popular. I was a big fan long before that, so I'm not a super trendy guy. But
fair. I mean that's totally fair. Okay, I'm glad we got that out of the way first, because I was going to say you probably must know One Shot by heart and all that stuff.
No doubt about that. Yeah, that's true.
Good stuff, man. Well, I know you've done a few other shows before, talking about investing, talking about your background, but, for those that may have not have heard your background or about TNT Capital Management, where did your passion for investing begin?
So I'd say that I'm rather traditional from a value investor's point of view. The usual stuff. I love the Buffett, letters. I remember reading The Intelligent Investor on a vacation in Hawaii with my dad. I was kind of just biding my time by the pool, and I just remember it really echoed with me. It made sense, and that was kind of during the tech bubble collapse. And I definitely lived through the mania of it at a young age, but didn't really understand what was going on. So then I, just started looking at all the different people, Martin Whitman, Bruce Berkowitz, kind of the early 2000s, people that were just dominating the market. And so that's kind of where I got my background. I worked at Vanguard Group. That was my first job out of college. So that was an interesting contrast because it was index funds, mutual funds. And during that period, stocks were tanking. The NASDAQ dropped, about 75% peak to trough. And so for me, as someone that saw the value in kind of the value investing template, I realized that wasn't the type of investing that I wanted to do. I wanted to kind of hand select each and every security for better or worse. And so, ultimately, I kind of developed my business plan, during that time and did what I wanted to do when I could.
Absolutely. So what ultimately led then to the founding of TNT?
Well, after Vanguard, I worked at a smaller firm that specialized in kind of option strategies. And so what they did was they basically did credit spreads on the S&P 500 and other indexes. And so I learned about options. And what's interesting about that strategy is that I don't recommend it to most people, but most options do expire worthless. And so, studying history, I realized, okay, there's problems with this strategy. I wouldn't want to build a firm around that. But I realized that if you could sell options on securities that you actually wanted to own, so if your biggest risk was, look, I'm exercised on this put on Citigroup, and now I have to own the stock at, a lower price. Well, then that's a great scenario because you're either making money from selling the option premium or you're willing to own the stock at a cheaper price. And I had read that Buffett did that in how he started acquiring shares in Burlington Northern Santa Fe. And so I was like, oh man, why doesn't everyone do this? And there are reasons for it. But basically I decided, if I could do a strategy like this, which is kind of like a hedge fund type strategy, but offer it to, the everyday, retail investor, that would be a really nice niche. And it's been a really good platform for us to grow from, because when people do kind of understand how it works, I often do get the question, why doesn't everyone do it?
Absolutely. So, you're kind of, I would say you're self-described deep value investor, right?
Yeah,
I think
100%. Yeah.
Okay, cool. So, Toby Carlisle has been my guy when it comes to deep value investing. I've interviewed him multiple times, so how would you say, how would you define deep value investing for yourself? Do you defer in how Toby looks at stocks as well, or how do you look at it?
I've read all his books. I love Toby. I would refer to deep value investing as buying securities at a large discount to intrinsic value. Not necessarily just buying great businesses for a fair price. I think that's kind of a big difference between deep value and maybe just traditional value investing. Kind of the newer Buffett model. So I like, big margin of safety. A lot of times I want to be able to withstand things going wrong. I mean, we've seen the tech bubble, we've seen the financial crisis, we've seen 2020, we've seen this bear market. So you need that margin of safety to really, feel comfortable. And I also think it gives you the most upside potential when you do get positive catalysts.
Absolutely. So you talked about kind of your hedge fund type strategy, using a lot of options when you go in and out of position. I had Matthew Peterson on here who also talks about, how do you know Matthew?
I've seen the name. I'd probably recognize him if I saw the video. Yeah. Gotcha.
Okay. So he talks a lot about his option strategies as well when going in and out of stocks. So can you explain that a little bit further because I'll be honest, I'm a self-admitted dunce when it comes to options. So I'd love to hear more there.
So I don't even love using the term options because the last thing I want to present myself as is like some broker peddling options. Not a broker. What we do is we use two strategies. That's it. So we do covered calls. So just vanilla covered calls. you own the stock, you sell a call at a price you're willing to sell the stock at. And if the call expires worthless, if the stock's below that strike price, you just increased your premium, and you still own the stock. Or if it, hits your strike price at expiration, you're willing to sell it. So that's pretty vanilla. The other strategy is just as vanilla. It's selling cash secured puts. So we sell a put on a stock that we'd be happy to own, and at a strike price that we'd be happy to own. And it's kind of like a flip of a coin. There's only two things that can happen if you hold that option to expiration. Heads, your option expires worthless, which means you keep 100% of the premium you collected. Or tails, you end up owning the stock at a cheaper price, and you've got all the upside or downside from there.
Very good. So then what does that ideal investment look like for you? We talked a little bit about devalue and all that stuff, but right now for you, what's interesting, or what's looking good?
I mean, a lot. I've been nerding out on conference calls and quarterly filings because this is when you can make a lot of money. And sentiment is polar opposite of last year, and even really the second half of 2020. I mean, that most people see the market down 20-30% at the lows for the NASDAQ. And, they seem to think, okay, well, this could be 50% down, and it could. I'm not trying to say that it can't, but I mean, you have a lot of stocks down 60, 70, 80%. So, I'm looking at a lot of different things. I'm looking for strong balance sheets, big disconnect between price and intrinsic value, good growth prospects. So a lot of those, I love financial stocks. It's not that I necessarily specialize in them, but they're definitely within my circle of competence. So there's definitely good values there, and also on the technology space, there's some across the board really.
There's this one phrase that I kind of dig when it comes to times like these, and it's the phrase fallen angels. In fact, we might be doing something for the magazine for our microcap review for Q3 talking about that. So for you, what does that mean to you? And have you been seeing a lot of these fallen angel opportunities in times like these?
Oh, I definitely think so. Yeah. I mean, one stock that we own is Lending Club, for instance. And so that was a stock that kind of meandered around for a long time. It was trading in the single digits. And I didn't really, I followed it. I thought it was kind of a cool concept. Basically it's an exchange for loans, for personal loans is how it started. And then, I read a really good report on Seeking Alpha from IP Banking, and it was in 2021, early spring of 2021, and they had just bought a bank, and so the business model just dramatically changed. So they're originating these loans at 14-12% spreads. And they were either, putting it on a warehouse line or, issuing asset-backed securities, higher cost of capital type stuff, unsecured debt. But now they were able to fund these, high-yielding loans, which they've underwritten pretty well in the past by using, deposits at virtually nothing, interest. And so it was very obvious that was a business that was going to see profits accrue and grow very rapidly. And they were just going to put more on the balance sheet. And so that's the stock. It rocketed from like 10 to 50, or I don't even know what the high was, 60. And then it's come back down, and now it's trading at around 14-ish. So I'd say that's kind of like, people saw it as fintech. Now they almost see it as more of like a bank, but it got sold off with all of the fears that are out there. And that's a fantastic growth opportunity that also trades at a value multiple.
Absolutely. I mean, when it comes to times like these, and you're, I've talked to a number of value investors and other investors, especially right now, where I don't know if it's necessarily kid in a candy store kind of feeling, but just because the sentiment is polar opposite to what it was second half of 2020, 2021, it almost seems somewhat difficult to say, all right, well, what should I look? Where should I look here? Well, should I look? It's almost kind of difficult to try and figure out, like, all right, where should I put more of my time and energy? So for you, how do you think about that? And where do you try and put some more of your time and energy when it feels like there might be a lot of deals out there right now?
It's a good question. I mean, I'm just really trying to focus on stocks where I really feel that there's, reasons why it can't blow up. And so I definitely don't want to take, permanent losses of capital here in this type of environment. I don't need to go for the weaker quality companies in the same industry. I think you could focus on quality and just really focus on, if you're getting a dividend, that's really nice too. So you're getting, if you can get a 4 to 5%, maybe 3.5 type dividend yield on a profitable company trading at a discount to what you perceive to be, liquidation value or definitely intrinsic value, that's pretty attractive, especially if they can grow. So I think there's a lot of opportunities there. I'd say a lot in the financial space where you have that much margin of safety.
Absolutely. So speaking of, we're in the throes of earnings season right now. What are some of the things that you're seeing? Are companies, how are they reporting? I've seen a few on the microcap side, so it's mixed results. So I'd love to hear your, it's always mixed results on microcaps. What the hell am I saying?
Yeah, I can imagine. Yeah, I mean, overall, I'd say bifurcated economy, where people are spending money. I mean, the Vegas is on fire. I mean, the Caesars guys were saying that I just basically business has never been better for them. And then Jamie Dimon said that commercial credit is the strongest in his lifetime. It's a strong statement. And then when you look at the consumer is strong. Credit numbers are good. But on the subprime space, you are seeing, degradation there. And so, I think it's a tough situation. People are spending more money, but they have to, it's just basic needs, food, rent, gasoline. And that detracts the amount of money that they can spend on things like a new TV or something like that. So it's a different, more service-oriented economy, and also more kind of like consumer staples, also trading down there. So we'll see how it shakes out. Unemployment will tell the story. If people have a job, I don't think the economy is going to fall down a cliff. I think it'll be a kind of like a 2000 and 2001 recession, where tech takes a hit. You see some layoffs there. Some companies are impacted, markets are impacted, but the general economy still kind of functions and does okay. If unemployment gets dramatically worse, I don't know. It could be a much worse situation.
Absolutely. And you mentioned earlier that one of your reasons you got into investing, how you got passionate for it, was reading all Buffett's letters. This is my quick transition into Buffett's recent quarterly announcement. Chris Bloomstrand actually put out a really great thread, providing a bit of insight on that. But as a Buffettite yourself, I mean, what did you think of his most recent Q2s?
I thought it was good. I mean, it's interesting to see Geico really struggle. Which I don't remember that in a long time. So I mean that they're feeling the impact like a lot of other companies. When they're repairing cars, the costs are extreme. To get the parts, and there's also huge delays and things like that. On the investment side, it's nice to see him more active. In 2020, it was kind of as a value investor and a fan of his, I guess you could say. It was kind of disappointing that he didn't get more aggressive in March, but no one knew what the heck was going on in March of 2020, so I can't really blame him. And there was a short window, but it's exciting seeing him get aggressive. It's also interesting with Occidental because there's so much history there. To see him kind of, buy when he did, it killed on it, and then not buy when it was really cheap, and then back up the truck, now that we're kind of in a bull market for energy again. I just think it's interesting. It's fun to watch.
Absolutely. Another question we're going on current events now, only because listen, I'm publishing this. Well, if you're listening to this, we did this interview on August 9th. But also wanted to ask you, because you've written about this a little bit, about inflation concerns and the type of outlook that you're trying to embrace with that in mind. So, what's your take on inflation, how that's affecting your portfolio construction or investing strategy going forward?
Well, so I've been concerned about inflation definitely, since 2020, when you saw the stimulus. I mean, you shut down the global economy, and the answer to that is just print an insane amount of money. That's not going to end really well. It's not going to end well. It's going to end with inflation. And so, we looked at kind of where bonds were priced at. I remember the junk bonds were yielding sub 5% yields. And so what we did was we invested in hardly any bonds, only like special situation type things. And then we kind of, focused on sectors that would benefit from inflationary or rising rate environment. And then for kind of the yield portion of our portfolio, we did a lot of, sold puts and stuff like that to generate kind of that income without necessarily having the interest rate risk of bonds. And so that's helped us quite a bit, this year, do better than the market, thankfully. But, the way that we see inflation now is I think the CPI numbers are going to be challenging for, the next year, because you have the housing segment of it, which is delayed in the way that it shows. It didn't show the full rise that we saw last year. And so it's going to take a longer for that to kind of reset itself out of there. But I think most areas, commodity prices, gasoline prices are starting to come down, food prices are coming down. I think we've hit peak inflation, is my opinion. So I think bonds have seen the worst of it. But I do think the Fed's in a really tough situation. I hope they don't raise too much. I think that would be a mistake.
Absolutely. So, I should have probably followed up with you when you said this earlier, and you mentioned how, it just so happens, in this environment or right now, it seems like your portfolio is a bit more weighted on the financial side. Mm-hmm. So I want to understand better a little bit as to why.
Well, I mean, margin of safety, so I'll give you an example of a stock that we've owned since, I believe, 2009, maybe late 2008. I don't. So Assured Guaranty, it's a bond insurance company, and what they do is if you're like the MTA transit line in New York or whatever, if they go and issue bonds, and let's just say hypothetically they have a triple B plus credit rating, Assured Guaranty has a double A credit rating, and by insuring that bond, the MTA pays a lower interest rate, and then Assured collects a premium based on kind of the spread between what the rates would have been and what it is with their guarantee. And so that's a company that's been plagued by Puerto Rico. When Puerto Rico defaulted, they defaulted on for Assured Guaranty's exposure, it was in excess of $5 billion of debt par outstanding. So it was a big, liability. And Puerto Rico just said, even if we can pay, and even if like we have revenues that are assigned to these bonds, we're just not going to pay. And of course, Congress, passed a restructuring law to enable them to do that. But that's a stock that it has a operating book value per share of about $90. It's got what they call an adjusted book value per share, which factors in kind of the present value of future premiums. That's at about $135 per share, and the stock trades at about 52. It's been profitable every year since it became public in 2004. So even with the financial crisis, with Puerto Rico, with Stockton, those different bankruptcies that occurred, they've been profitable. And what they've done is they've bought back 70% of their stock over the last, I believe it's 8 years, at huge discounts. And so you've got a company that doesn't have a high return on equity, but they've grown book value at a rate that's comparable to any insurer that I'm aware of, a book value per share, I should say. So that's the type of thing where it's not a sexy business. Most people don't know what the heck it is or what it does or why you'd want to own it per se. But it's one where you do have a very large margin of safety, and you've got a management team, that you can trust. I've seen their track record. It's the same guy since 2004 when they went public.
So another question I have for you, and this is actually going back to, where your passion for investing began a little bit. But I mean, did you have an experience or an investing experience that kind of shaped a little bit as to why you're now wanting to focus on margin of safety, either then or actually even a recent example if you got one of those?
Well, that's a good question. I grew up. I was in high school in the 1990s bubble. So you saw just people getting rich, people seemingly throwing darts at stocks. I mean that's really what it was like. It's kind of like 2020, 2021 were in a lot of senses with crypto and all that stuff. I mean, there's a lot of parallels, and so to see that collapse I thought was really interesting. So you see that collapse and you see these high flyers, everyone thinks it's so easy, and then all the day traders are gone. No one wants to touch the stock market. So I found that very interesting. And then, you see they wrote off Buffett in whatever that Fortune or Forbes article was when they put him on the cover, is he done? And then what are the great stocks coming out of that recession? It was those, PNC companies like a Berkshire Hathaway, the Markells, the Fairfaxes that rose like a phoenix, And so I think that by nature, I'm contrarian. And so I got really interested in that. I mean, it's been an interesting run for value. As you know, as Toby can attest to too, it's just value was so out of favor, just like those 1990s. So we'll see if that turns around or not. But I'd say just that.
Well, it did have like a moment earlier this year, right? So what was so that was, it had the moment, it might, right? I mean, so that must have been a little validating at the time, and we'll still see from there, right?
Oh, absolutely. No, I'm very comfortable with where it sits at. It's one nice thing about kind of incorporating like the covered calls and the cash secured puts is you don't have to just be 100% long stocks. There's multiple ways that you can profit. And so that's really helped us during kind of this, value era. And so, yeah, I think if you look at where the market's at, the market's not insanely cheap. There's areas that are cheap and there's stocks that are cheap, but you could see another lost decade. I remember 2000 to 2012, a lot of stocks, Microsoft, the market, it really didn't do much. Same thing for 1964 to 1982, the market didn't do much. If you get a period like that, buying undervalued securities is going to be a huge way to benefit when other people really aren't making money.
Or just buy undervalued securities and hold it for 15 years or something.
Yeah, it's true.
Right.
Yeah.
Well, for you, what's your normal hold time? Are you one of those where it's like ultra long term, or do you have kind of like some of your own mandates?
A lot of stocks we've owned for years. A decade is not uncommon, for us. But I will say it's a little different though, because we're using covered calls, we're using cash secured puts. There's a lot of times, we're selling it. Like we sold Citigroup at tangible book value per share. We sold it, which is right now is around 80, and we own Citigroup still. So we sold it before and then we bought it because whenever the market has the sniffles, banks tend to sell off quite a bit, and Citigroup alongside it. And so, now it's trading at, $51, $52 a share, a huge discount to tangible book value. Now we see it as quite an attractive buy. That's another one of those where you get like a 4% dividend. You've got stock buybacks. They're limited on that right now. But, it trades at 5 or 6 times earnings, and those earnings should grow, nicely. They're benefiting from higher interest rates. They're well reserved for credit to get a little worse if it does. They benefit from volatility with their trading businesses. So that's the type of thing we'll once we understand a company really well, we're able to kind of take advantage of the ebbs and flows in it.
Absolutely. So to kind of close the book, I guess, on some current events, because I asked you about a few of them already. Is there anything that we left out, or is there anything that's super interesting to you that you've been following or watching a little bit more closely?
One thing I'll just add on with the stock I told you about, Assured Guarantee. What's one thing so Puerto Rico, I think it went bankrupt in. I think the restructuring started in 2016, basically. 2015 is when it became obvious that they were going to, and then 2016, I think, is when that new law passed. So now it's 2022, and finally it's getting resolved. So we're down to like 2 more credits out of what was like a dozen that defaulted. And in mid-August, the one that was most dangerous to Assured Guarantee, which is the Highway Transit Authority, that should get worked out. It should be finalized. They have a deal in place, and it should be finalized in the next month. So that's the biggest risk is going to be off the table for that stock. And then there's only one. There's the utility left, which they've already had consensual agreements where it would be a 95% recovery. So it's not going to be a big deal, in my opinion. So that's just something that people might watch. The Puerto Rico, that was your question that you asked a minute ago about like interesting things in deep value. I remember I believe it was 2015 or 2016, those bonds, the general obligation bonds for Puerto Rico, they were trading at like 18 or 20 cents on the dollar. And in Puerto Rico's constitution, they are above like employee salaries. They're the most ironclad, security in that constitution. Of course, they changed the law, so it's a lesson. I mean, just because you have like the legal right doesn't mean that you're necessarily going to fully benefit from that right. Things can change. But those bonds, they traded up to like 85 cents on the dollar, 80 to 85 cents on the dollar. So it's just that's deep value in the fixed income arena.
Very good. So, I asked this to almost everybody on here as well, in terms of your research process and channel checks and whatnot. Do you talk with, I mean, you don't really focus, I don't think, in microcaps all that much, but I mean, do you talk with management? What kind of channel checks do you do? Love to know.
I love that question. Yeah. I mean, yes, when I can, I do talk to management, and there's, we're just under $100 million. So we're not a huge firm. But I found that companies that I trust, after getting to know them better, they're usually more willing to engage with investors, especially if they know you're a long-term investor and put in some work to actually understand the business. So absolutely I do. And I like the microcap space quite a bit. I always kind of had the desire. I love activist investing. I love seeing what some of those guys do. It's very expensive to run proxy contests and things like that. And I have seen when I've invested in microcaps in the past, I've gotten frustrated because I'm sure you've seen this situation a million times. You'll have like a huge net cash position, no debt, a profitable business that's cash flowing nicely. And so it's like, okay, well, why not just buy your stock back or really, if you've got a great investment opportunity, do it. And then it's like, okay, you do some egregious acquisition at a very high price. And so I got burnt by that a few times. And so that's why I'm not as active in that space. But I'm definitely open to it.
Well, what else is holding you back? I mean, hey, getting burned by that, I hear you all day, every day. It's more. It's annoying because it's not just the management team that also like thinks that they need to do that kind of acquisition.
Yeah,
it's also a lot of their shareholder base saying, "Hey, you got to do something with this cash."
It's true.
And then they go out there and make a dumb acquisition because they're like, "Hey, you guys said you wanted an acquisition. What do you want from me?"
Well, and they're more susceptible. They're more susceptible to that one strong shareholder who could buy a large. I mean, I've seen that too, where you have like some really rich hedge fund manager that basically, has management by the balls, and they can even manipulate that to benefit other businesses that they own and things like that. I mean, I've seen stuff like that, but I'd be open to anything on the microcap space. I guess just right now I see so many opportunities, even in the large cap space, that I just don't feel that I'm kind of just focused on where I know better, and I know those opportunities more right now.
For sure. And look, dude, when it comes to market downturns, microcaps are always the first to get hit and the last to recover. So you got time, probably.
Yeah. Well, hey, I'm open. If anyone has good ideas in the microcap space, I'd love to research them. Absolutely.
Oh, for sure. Is there anything we've missed on the deep value side that has been coming up that's interesting? It's a weird time because it seems like a lot of these types of conversations, a lot of these types of thought pieces on value investing have kind of been already sussed out in some respects, so that's why I like having these individual talks, because there's always something that we're missing, So, I mean, for you, what is it?
I think stuff like, I mean, I know a lot of people probably say this, but I think stocks like Google, stocks like Facebook. I don't go by the new names as much as they're Google and Facebook to me. But if you look at, the valuations that they trade at, the return on invested capital of those businesses, the strong balance sheets, not a lot has to go perfectly well to make money on them. And I remember when Buffett bought Apple, it was not a typical move for him. But I mean, obviously it paid off really well. And sometimes, you just swing for the easy pitches. So I think for people that, kind of didn't participate in the massive bubble that occurred on a lot of those tech stocks the last couple of years, you have an easy opportunity there, for at least a portion of your capital to buy it at attractive prices. Doesn't mean it can't go cheaper, but I think that's a nice holding to have. Kind of boring, but maybe, but good businesses, which is nice, especially when you're on the deep value side. When you can get return on capital like that, you should jump at it, especially at teens multiples.
Very good. And real quick, are you a shareholder in Google?
Yes, sorry about that. We own both those as well. Yeah, we don't own Apple. We don't own Apple.
Gotcha. So you also mentioned that, you talked about financials, how that's been kind of interesting, but you also said a little bit of tech as well. You even just said it too, that there are some of these opportunities in tech. So what are some of the things that you're looking for in that respect, other than just being like, hey, it's cheap? We also, we want to now make sure too that they're good businesses. So what about the ones that might look cheap are also then good businesses in your opinion?
Well, so I watched your interview with Toby recently, and I think one of your questions was, what's the qualitative factor that's most important to you? And I thought about that, and my answer would be just trust in management. So I remember Hewlett Packard when they made just horrendous acquisition after horrendous acquisition with Carly Fiorina, and I believe Mark Hurd was part of that too. And then Meg Whitman came in and really righted the ship. So you had a really cheap stock, but she was very clear. She's like, we're not going to do, these acquisitions. We're going to focus on cash flow, reduce debt. We're going to buy back stock when it's cheap. She just did an excellent job and totally turned around that company. So I'm looking for, when I'm on the tech side or any company, I just want to trust management. Are you going to do what's in the best interest of shareholders? Upstart is a stock we don't have any position in, but I'll give you an example of how stuff can be so strange. They are having trouble selling their loans that they originate from their algorithm. And so they decided to use their strong balance sheet to put some on. So they put some on. And then they're like, no, we don't want to do that. The market reacted horribly to it. So they sold a bunch of these loans at huge losses. And now they just reported earnings yesterday, and they had their conference call. Now they're expanding their balance sheet again. This is all within like 1 quarter. So that's a management team that, frankly, they've done some really great things, but I wouldn't trust them to make them like a big position or anything like that.
Gotcha. All right. No, that's a good thing. That's a good thing to listen for. I mean, and we've been listening to some of these conference calls, at least on the tech side, from the transcripts or some of the calls that you've listened to. What has been kind of they all end up saying something along the lines that's very similar, whether it's blaming inflation for, poor sales growth or, poor margins. But what's been some of the, I guess, common things you've heard thus far on some of these calls that you've heard?
Just kind of weaker ad spending is the common theme, really. And just, so a lot of them are just not getting back to, a lot of the pandemic and lockdown beneficiaries have just seen that really deflate. I mean, people are going to the malls again. Malls are actually doing really well. It's an interesting time. So you're just seeing that the idea was that it was accelerating growth in these industries and that wouldn't come back to normal. And it really has kind of come back to normal. They'll still, online still growing, of course, and whatnot. But it's been interesting to see that bubble deflated quite a bit.
Absolutely. All right. So only a couple more questions for you here today. I asked you earlier about an investing experience that, kind of guided you in your career, but what would you say is an investing experience that really changed your career the most?
Well, that's another interesting one. I mean, I'd say like in my professional career, owning my business, which we're going up on 11 years, definitely a sure guarantee. because I've owned it for so long, and we've made a lot of money on that over time. But I'd say I learned a lot during the financial crisis, because I remember you had like Wally Whites, or I don't know if you're familiar with that guy. He's a fund manager. I'll never forget him being on CNBC and talking about like countrywide financial. I was like, well, it's trading at 4 to 5 times earnings, and yeah, they're dealing with short-term hiccups in mortgages, but this is the type of stuff. Or Bill Miller when he was talking about Bear Stearns, and so from a statistical standpoint, those stocks were a value investor's dream in many ways. From if you're just looking at kind of the quantitative factors, but you have to understand, how do these businesses blow up? And that had never happened. That had never happened. A housing crisis like that had never happened. So I would encourage any younger investors, getting started, really think about, how does this business blow up? And how do we make sure that we have protection from there? Now, banks are really different with the way capital they have, the regulatory environment, the way that loans are underwritten. So seeing that just day after day, huge companies just blowing up like that, it makes you really want to focus on the balance sheet, probably more so than most people would.
Very good. All right. So to close this out here, what advice would you have for folks that are looking at the markets right now, or even maybe to some of your friends and family or anybody that's giving you a call right now, be like, yo, what the heck's going on? So what's some advice that you'd have for them?
I'd say understand what you own. There's a lot of people that kind of got into the crypto space, and many have made a ton of money, and I applaud them for it. But just make sure you understand what you own. Like the Celsius bankruptcy, that was Madoff in size, and if I remember when I had a prospective client who actually became a client, and he was explaining to me how he was making 20% loaning his crypto, and it was very clear that this was going to be, some type of scheme that was going to end up terribly, because it's just economics. It just does not work like that, so understand what you own. And so if you're an index fund investor, that's great. You'll do great over time. If you're a mutual fund, just plug it into T. Rowe Price, that's cool too. Or if you like individual stocks, but have a strategy and don't deviate. The people that really do it, if you're a value guy that got into growth in 2021, you lost a ton of money both ways. So I think staying true to your methodology and understanding why you invest a certain way and what you invest in, I think is the critical element.
It's a great place to end it. So Tim, where can my audience go and find more information on you, TNT Capital Management? Plug away.
Sure. So our value is our website is ttvalueinvesting.com. And so you can find us there. And my Twitter handle is Tim Travis Value. And yeah, absolutely. If you need anything.
Very cool. Well, Tim, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And look forward to meeting in person at some point soon. You're from California.
Yeah. Thanks so much for having me. I appreciate it. It was fun.
Same here. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.